All right, well, those are UltraTech Cement's numbers that are flashing for you on the screen. The top line is a little bit better. The net profit is bang in line with what we are working with. We're waiting for further details out there, but I think the consolidated numbers should be flashing for you on the screen. I'm just waiting for the EBITDA number. Well, that as well is pat in line with what we are working with. So we are talking about a growth on the top line of close to around 15%. So that part of the benefit of lower power and fuel costs has definitely played out. And that's why these numbers are in line. Volume numbers are already in. The consolidated volume growth, in fact, is already in as well. So it appears that these numbers actually are bang in line with what we're working with. No big scare in terms of, the big spike up that we would like to see in other expenditure. There were two factors that could have played out. One is we were watching out for salary revisions. The second factor was the maintenance cost as well could have come in higher. So UltraTech's numbers go down bang in line with what we were working with. I'm trying to wait for some management commentary. The management has said that, in fact, they've achieved capacity utilization of 75%. We know that. The energy cost was lower by 10% on a year-on-year basis. So that's where they've got some kind of benefit. Raw material cost, though, was higher owing to the increase in fly ash as well as slag. So the reason that these numbers are in line is because the energy cost has come down by close to around 10%. Rakesh Arora, founder at GoIndiaStocks.com, joins us on the show. Hi, Rakesh. Good afternoon. Thanks so much for joining in. Well, we're looking at the numbers, and prima facie, it looks pretty much in line with what we were working with. The power and fuel cost benefit has flown through. Other expenditure was likely to move up, and that's precisely what's happened. Your first take on these numbers?
So, Nigel, I think the numbers are slightly ahead on the EBITDA level. I think Street was at around 2650 crore, and I can see it's around 2700 something. So, a slight positive on that account. Volume numbers were very impressive, and it came earlier, so there's no surprise out there. But overall, I think it's a decent show. Power and fuel cost quarter on quarter has kind of stable. It's gone up a little bit. But let's understand that this quarter is normally a weak quarter. And QOQ, the volumes are down 11%. And that's why the other cost actually goes up. So, and normally companies do their maintenance shutdown also during this quarter. So the other expenses like stores, spares, etc. also, move up. So keeping that in mind, more than 1,000 rupee per ton EBITDA per ton margin seems very good.
Indeed. We'll get further details in the presentation as well, Rakesh, but I just want to read out some commentary that they've given going forward, and they're sounding very optimistic. They're saying that demand revival is imminent, especially the festive season and the Jan to March peak construction period. So that's good news as well. They're also saying that demand will be led by pre-election spending, continued government push on infrastructure, and sustained real estate development. All this will go well for them. So the past quarter was a monsoon quarter, and it seems they've done fairly well. Rakesh, we'll keep this short because we'll wait for the presentation. But what's your view on the stock from here on? You had Dalmia Bharat actually, numbers were pretty much in line. The stock corrected the next day, though. A couple of downgrades did come in there. But the second half of the year, they as well are talking that it'll be quite good. From the large cap names, what do you like?
So I think UltraTech is one of the best plays out there because, one, despite their size, they're growing the fastest. They're capturing market share. Their expansion plans are looking extremely solid. And as we saw that even in a lean quarter, they have notched up a margin of more than 1,000 rupees per ton. And with cement prices having moved up substantially in Q3, I think Q3 and Q4 are looking extremely promising.
Okay, all right. Rakesh, just one more word out there. The net debt number has come up on the screen. It should come up for our viewers as well. The last reported number was around 2,700 crores as of March. Now, this number has come in at around 4,917 crores because they have been spending on, capex. So the updated debt number should flash for our viewers as well, 4,917. Rakesh, final word then. What kind of an improvement you're factoring in for the second half of the year? Input costs are likely to be lower, volumes will pick up, and price increases as well have been absorbed, particularly in South and East India. Your take?
Yeah, so see, in the current quarter, the capacity utilization was around 76% for the company. In Q3 and Q4, I'm expecting that they will be doing upwards of 90 to 95% range. So volume growth would be substantial, and as we discussed that given that cement prices have gone up, margins are also going to look up. So, meaning this is looking like a blue sky scenario for the second half.
Okay, all right, Rakesh. Thanks so much for joining in and giving us all of those details. So that's UltraTech Cement. Those numbers look pretty much in line. The street was fearing that maybe there'll be some kind of disappointment coming in from somewhere, but that's not the case. The operational performance is bang in line. The debt number has moved up marginally, but that's par for the course because they're expanding capacity by close to around 20 million tons odd. And the commentary is very, very positive. I think these numbers go down well with the street. Explains why the stock is up close to around 1% or thereabouts. No big disappointment, and that's something the street likes.